cannot assure you smooth alpha. That's unlikely to happen because I'm 80% away from the bench.
What's your scorecard, or what's the frequency and the cadence of it?
Very short-term performance evaluation is only going to give you noise.
Where are some of the constraints and profit pools that are being generated today?
Most of the time, most of the stress is that am I owning the wrong stock?
When you meet managements, what are you essentially looking at?
You also want to evaluate management by their body language. Sometimes the body language also tells you a lot.
On a one-year basis, your fund has been an average fund. Explain me what went wrong. Those philosophies aren't perfect. They are built on assumptions. They are shaped by biases, and those philosophies completely break when the market turns. That's why we are here. The Ramneek Kundra Show is where we question those philosophies. I am Ramneek Kundra, and in this series, we are not talking about performance. We are talking about the thinking that drives it. So I have Bhavin Gandhi with me today, who is a fund manager at DSP Mutual Fund, and he manages two schemes over here. So hi Bhavin, welcome.
Thanks for having me here.
Thanks for coming here. And I want to first start with the mandate you managed through these two schemes.
So the way I think about both these mandates, I mean, apparently they may look a little different in the sense that Flexi is the one fund which I manage as a diversified mandate. The other being focused, which is the concentrated mandate. So apparently these are different mandates. But if you think about if you think beyond concentration and focused, the diversified nature of these two mandates, I think there are a lot of similarities here in the sense that the broader benchmark is more or less the same. There are no constraints in terms of the market cap buckets that I can get into, be it large, mid or small. So I can have allocations to each of these buckets as per my understanding of value. So no real constraints in both these mandates. The only difference is, like I mentioned, concentration and diversification. And the way I think about this is that in focus, I would want to be stock concentrated. And in Flexi, I would want to be theme concentrated. So probably that's the only difference between the two. And given that one of the mandate is slightly larger in terms of AUM, sometimes that does create a constraint if I want to build or participate in a theme where the liquidity is lower, in which case I would have more than one name in a theme.
So which one is the larger
Flexi
AUM?
is the larger AUM, more than 10,000 crores. So that's where if I want to participate in a theme and there is not enough liquidity in the names in that theme, then I'll probably participate through more than one name. In focus, generally, I would want to restrict myself to one or two names in a theme.
Got it. So in terms of playing the themes, you said, how do you go about thinking about themes? Because when I was reading your framework, investment framework, in that you mentioned that, you look at intrinsic value, you are looking at growth of the company, you are looking at all the factors that are cost of capital, all the factors that are important in calculating that intrinsic value. And in that, you also mentioned that you are neither growth or nor value investor. Is that just a label that basically, you refrain from, or is it the style as well? Because to me, what you do seems like value investing at its core.
Absolutely. The way I think about this is that I think every good investing style is value investing. I mean, I'm yet to come across a fund manager who deliberately goes out and buys overvalued stocks. So that doesn't happen. So the way I think about value is that how do you define value? So, for some it would mean maybe buying stocks which are in low multiples or are trading at valuations which are lower than its own history. Maybe that's value for them. Or what is conventionally defined as buying a stock for what is less than its worth. The difference between the two is the value. But I think the more eloquent definition of value for me is buying stocks with low embedded expectations, right? So, the problem with valuing equities is that unlike a bond, the coupon is not printed out there, right? So you need to think about the cash flows that will come out of the company over its life and appropriate discount rates. So instead of trying to solve for all of that, what I do is I take the market price as a given and see what expectations are already built into the price, and then go out kind of deciphering whether these expectations are realistic or not, and if there is margin of safety, and I think company can out deliver those expectations, is what is value to me. So that's how I kind of think about.
So you're mentioning margin of safety, you're mentioning price versus value, you're mentioning low embedded expectations. All of this is value to me. So why refrain from...
So sometimes you tend to associate, with these labels, and then you find those characteristics in the stocks that you're kind of buying into. So that is what I want to kind of move away from.
Yeah.
In fact, in my framework document, also, I principally what are my basic principles for constructing the portfolio. I think there are three things. One is low embedded expectations, which is implied expectations that are built into the stock. Second is where the businesses are in their cycles, and third is position sizing. These are three very, very critical pillars for my portfolio construction. And then within that, you can have multiple nuances. So, for example, what I then do is think about stocks in different buckets, which are not necessarily labels. Okay, so basically, let's say, high growth stocks which can deliver growth for multiple years. Then commodities, you can have PSUs and cyclicals, etc. So each of these buckets will probably need us a finer nuance to evaluate them versus just those three principles that I talked about. So that is where I differentiate.
What I understand is what you're saying, some people do value factor investing. That's not who you are.
You in my portfolio, probably you will find a Bajaj Finance, and you will probably also find a PFC.
Yeah.
Bajaj Finance is
5p versus 35p.
Investors who say they are growth investors.
Yeah.
And probably PFC will be seen in portfolios where people say that they are value investors.
Correct. So you are a non-dogmatic investor. It doesn't matter to you what multiple is company trading at.
Correct.
You're just looking at the embedded expectations and your growth expectations over there, and reasonably generate a return from that. So the markets went through this kind of a drawdown between 27 September and February 28, right? 2024 and 2025. Do you believe that you missed an opportunity to significantly kind of stand out?
That's a good question. And maybe the way I think about this is that, let's say I started managing Flexi from around March of last year.
Mm-hmm.
And if I look at the attribution for about 1.5 years, the overall alpha on a gross basis would be around slightly over 5%.
Okay.
So I don't think that's a bad outcome.
Oh, that's good.
So basically, if you then cut and you use various time frames, like if you look at a 3-year horizon or a 1-year horizon, I don't think we are doing justice, because I was not managing the fund before that, and 1 year obviously has been a roller coaster. But if you look at the period in which I've been managing it, I think the outcomes have been decent so far. So the things are moving in the right direction. So to your point is that the idea is that you work with a certain thought process, certain philosophies, and in that frame, mid cap and small cap names scored a little higher, and that deserved a larger allocation. And in a volatile period, these kind of underperform the broader market, and that's last year, and that's probably what played out. But if you look at in totality over the period that I'm managing, the outcomes have been fairly decent. So yes, you would want to kind of deliver a decent outcome, but from time to time you will have these periods of underperformance and outperformance.
But what I am seeing is you also kept kind of 5-6% cash throughout this period, right? And the 100 basis points kind of alpha since you kind of began managing from 1st Feb. That's what it shows on value research when I look at it. So, since that time to until now, which was 31st August, it shows me that you have generated kind of 100 basis point of extra return over the benchmark, and I believe that actually came from the cash position. So
I think the way one needs to think through this is that cash position was not a deliberate attempt to have cash in the portfolio. So I inherited a certain portfolio, and I wanted to kind of bring it towards where I think that portfolio should be, and that meant that I was churning the portfolio over that time horizon, and that meant that I would have a certain cash position because I was building into a certain name and I was getting out of a few names, and that's why that the outcome was that I had some cash position. That was not the deliberate attempt. Generally, my approach is that I would want to be fully invested. I don't want to take very large cash calls. If the investor has given me money, he's probably given me money to kind of deploy it. So generally, I don't take very large cash calls in the portfolio. You would have seen that in Focus as well. At one point in time, we did have a large position, but that's not a deliberate attempt to.
It's a residual of whatever you do.
The way we are kind of operating. So that's the way I would kind of put it.
And balancing kind of two strategies over here is a bit needs like a mindset shift when you wear a focused manager hat, and when you become a flexi cap manager, which has 50-60 stocks in it, and as a focused guy you have 20-30 stocks in it. So how do you think about building those positions? As you said, you try to play themes, and from those themes you would have in one theme you would see 4 or 5 stocks, and out of that you are taking out 1 or 2 stocks and putting that in the focused fund. So that must be a lot of deliberation that comes after it, and I've seen that focus returns are better than flexi caps return
over the full horizon it is, but I think over the period that I've been managing, I think more or less the outcomes have been similar. I would not say it is exactly the same, but they have been similar.
Okay.
But it's a good question, and I can kind of think about it myself a lot. And the way I think about this is that ultimately I would want to participate in a theme, right? And the focus design forces me to restrict the number of names that I can have. So that's the approach that I take. But like I mentioned, sometimes this becomes a constraint to build a name in a larger portfolio. So it's slightly more easier in some sense to build it in Flexi, where I will have 2 names or 3 names to participate in the same theme instead of just one. So that's the only difference. If you look at actually the stock commonality of both these mandates, it will be lower. Obviously, it will be around 40-45%. But if you look at theme commonality of both these funds, it's actually 70%. So there is you are largely participating in the same thing, which is what matters to me. Names could be slightly different, and obviously Flexi will have slightly more number of names versus.
I'm trying to understand this, since you're looking at things from implied expectations point of view. So why even think about themes?
This is not just the expectations frame that I've built from what Michael Mauboussin has put out in his book. And we just go a step beyond that as well. So what I actually go about doing is look at not only what is baked into the price today, but we go back doing the same exercise for the last 10 years. Okay. So when you do that, so let's again unravel what are the fundamental drivers of value, right? It's the return on capital, growth, and cost of capital. And all of these variables are constantly in a flux. They are changing over time. So when you look at the multiple of a company over a time frame, it does not tell you the full story. But if I back solve for the valuations at various points in time, where all these 3 factors are changing, and I say what is the market thinking about this stock over this time frame, it gives you a great dimension to think about how the market has thought through this name over a very long period, and what will it take for the market to change its view. And market very seldom changes its view on a name. So when there is a regime change, this frame helps you take a much better perspective on a name. This is how I think about when I'm kind of buying into a name. This kind of helps me think through as to how the market has been thinking about this, where is the change happening, and should I be participating at this point in time. And when I run this screen over the entire universe and slightly beyond that, it gives me really interesting names to kind of work with. If there are a cluster of stocks which belong to the same theme, then it's telling me that probably there is merit in kind of investigating this idea.
Your approach kind of sounds to me like, you know, you are looking at something bottoms up, but at the same time you are also looking top down, how the structure of the industry is evolving or the theme is going, right, in terms of price and value. Is that correct?
So the way I would think about this is it's the nature of the mandate, right? So you have a very broad universe to screen from, right? You have a very broad. I mean, you probably are looking at 600 names at any point in time, which means that it's physically impossible for me to investigate these many names.
Yeah.
So what I do is I let my frame throw up ideas for me. So what works for me best is elimination rather than selection.
Right.
So what I do is that my embedded expectations frame, which I run on the entire investment universe, throws ideas at me, and then I'll deep dive on those. So if you remember, I mean, this is a part of Professor Damodaran's course, where he says he uses relative valuation to screen ideas and then runs DCF to deep dive into them.
To go absolute.
The other way, where I would run a reverse DCF first to give me ideas and then deep dive on them.
Okay, so you go absolute first and then relative. Then you'll figure out what the other companies are trading at and everything. Okay. Now you're looking at something top down and you're looking at something bottoms up. So you're doing both of those things. Do you also look at macro, and do you also think about it sometimes? And as long-term investors usually think like, over long term everything is going to just average out, and then there is another long term school of investors which basically say, in the long term we are all dead, coming from Keynes and misquoting him a lot of times. And so where do you kind of belong? Because most of
There's one school of thought which kind of also says that if you spend 10 minutes looking at macro, then that's 10 minutes wasted.
Yeah.
So I'm not of an extreme camp on both these sides. What I tend to do is I'm aware of where the macros are. For example, an interest rate regime is very important input into my value equation, right? If that regime is changing, I need to bring that into my intrinsic value calculation and see whether I have enough compensation for that risk that I'm taking. But other than that, I'm aware of where the macros are headed, but I don't take my investment decisions, which are primarily driven by these macro changes.
Yeah, Buffett was, I remember, once asked in 2022 when the interest rates were zero, and a news anchor basically asked him, what do you think the equity valuations are doing over here, and do they look expensive to you? And he said, where the interest rates are, the virtual value is infinity. They can trade at any multiple and you could justify that. Do you also look at news the same way a prop trader would sometimes look at, preempting it, or sometimes reacting to it?
So the way I would want to look at any news, particularly if it is relevant for the companies that I own, is whether in any ways the original thesis with which I bought those names is kind of changing because of this.
Yeah,
that is the only news that matters. And in some sense, is it going to impact my cash flow, my risk profile, or my cost of capital? If none of these factors are going to be impacted by a given news flow, it doesn't matter.
Is there any example that you can give when actually your thesis changed because of the news flow and some governance news came out, or business model news?
This is something that I spend a lot of time doing, is go back to attribution. But I'm sure you have heard about this story of Abraham Wald, where you had these in the Second World War, where the planes were coming back, they were investigating where were the bullet holes, and they wanted to obviously fix it. And then this statistician Abraham Wald said that the planes which have not come back have been hit probably in the engine, and that's why they did not come back. So you don't need to fix the spots where the bullet holes are there, where you can see it, but probably you need to armor the engines and the cockpit.
Correct.
So probably what happens is, if you have wrong attribution, then you will probably fix the wrong thing. So what I tend to do is that I have a 2x2 grid, a good and a bad decision and a good and a bad outcome, right? What I want to have is ideally larger proportions of my decision going into the bucket where the decision has been good, but the outcome could have been good or bad. And that's how I investigate every idea. So, there is no hindsight bias that you are working with. So let me give you a few examples which can probably help you understand the way I think about this. So let's think about a scenario where I thought that decision quality was good, but the outcome was not great. Okay, so let's think about lenders, for example. So when I'm looking at lenders, I generally don't want to roll down into tier 2, tier 3 names, right? Because you don't really understand the quality of the book that you are kind of getting into. So the strategy is to stick with tier 1 players most of the times, and these are leverage businesses, right? So if you take a wrong call on the underwriting, then it will hurt a lot. But there was this one time when we decided that there was a gold finance company which was looking very interesting, and I specifically was interested in this because you would know that gold finance companies have very low loss given defaults, and that's because the LTVs are 75%. You don't take into account the making charges in the collateral, so a lot of buffer is really there when you are buying into these names, right? So that was the one piece, because 70% of that company's business was gold finance, which meant that it was largely a secured business. The other thing which I liked about the business is that the company was rapidly expanding its branch network outside the what is conventionally a gold finance market, which is outside the south, right? And the branch network expanded by 29% over the last 5, 7, 8 years. And the AUM was not growing at the same pace, which meant that there will be a big operating leverage which will play out in these names. So that was the other rationale that I was looking at this name for. The other thing is that at that point in time, a lot of gold finance companies were not getting approvals from RBI to expand their branch networks, whereas this company had an approval, which means there was a tacit approval from the RBI also that you can expand your branch network, etc. The best rating agencies of the country had given investment grade ratings for this company also, and there were the pedigree of investors that were there at that point in time also give you confidence that this is a good company to own, and that's why we thought that this is an investable name for us. But after having invested, you remember those RBI rebuttals which came for most of the lenders, right? And it started out with this name, where they asked them to stop the business. I thought we had done enough diligence on that name, but it was a stroke of luck that this was the first company where RBI said that you need to stop your business. Yeah. And it was an industry practice which they need to course correct.
How large was the position at that?
So fortunately, the sizing framework took care of it. Yeah. So generally, when I look at a small cap name, they generally are less than 3% position. This was about 2% position at that point in time, but it does hurt. That is maybe an example of, let's say, the decision which I thought was good, but the outcome was pretty bad. And then you can have a scenario where the decision quality was not great, but the outcome was not bad. So let's think through this also. There was another insurance name that I was looking at, right? And the basic thesis behind this is this was belonging to one of the largest banks, private sector banks in the country. And you would know that these insurance companies have different distribution channels, and most of the banks back their own insurance companies while distributing these policies. But here was this company where the parent company was not backing this entity, and that's why the overall growth was kind of moderating for them. And that was the single biggest challenge that one had in that name. But by the time we started looking at that name, the salience of this parents channel had already come down to a very, very low number.
The life insurance company.
The life insurance company number, which meant that if the other channels were firing, then you would see that the growth will start to inflect. That was the basic rationale. The price to EV, which is equivalent to price to book for insurance companies, was less than 1. And I thought this
embedded
value, and which is equivalent to, let's say, in case of banks, a price to book number. Right? It was less than 1. And if you are doing a decent ROEV, it meant that the outcome should be fairly okay. And which was the investment thesis. But what we probably missed out looking at is the operating variances. And in case of life insurance companies, you would know that these companies need to make assumptions about mortality, about persistency, etc. Which when you are kind of giving out these policies, and you have to be conservative on those. And if you start seeing negative variances on this, it means that your assumptions were not very conservative. In fact, we should have looked through this, and we realized that even before we had started to invest in that name, the operating variances were negative. We kind of missed out, but we focused on the other part of the story. But fortunately for us, there was a change in management, and there was a lot of investors chasing that name because of the management change. And we could fortunately realize that the other channels were not firing, even though the bank salience was going down, but the operating variances were continuing, and we could get out of the name because of the euphoria because there were investors looking at that name just because of the management change. But that I thought was probably where we did not kind of look through the entire story, and probably the decision was not great, but the outcome was not bad eventually.
Can you walk me through an example of where you kind of course corrected? Like, you were sure that you were wrong. Here, the outcome turned out well. Earlier, you figured out, kind of you entered early or something like that. But here, let's say you buy a company which is one of the largest positions, and you think this is your limit, that you have reached in terms of position sizing, and then it starts correcting, and you thought it was the right price to pay, and it doesn't seem like there is no news on the name, or nothing bad has vocally or virtually visibly come out. How do you course correct on that? How do you think about like averaging down, averaging up in these kind of names?
Sure. So the way I think about this is that what is when I've kind of written down my investment thesis on a name, I get an opportunity to reinvestigate that thesis every quarter, right? And every 6 months I would have the balance sheets also, so I would kind of reinvestigate my thesis on that name. In fact, the best names that have worked the best for me is where the stock price is not reacting, but you can see your thesis playing out very clearly, right? These are kind of best opportunities, and you are very comfortable with those kind of names. Although the stock price is not reacting, your thesis is exactly playing out the way you want it to. But then there are cases where you can see that you had a certain thesis, but that thesis is breaking down, and either the stock is going up or is not reacting. Those are the names where you really have challenges as to what you should be doing, because you clearly see that the thesis is kind of breaking down. In which case, I'm very dispassionately willing to cut down my position on that name. But as long as the thesis is intact and I can see that thesis is working out, but the stock is not reacting, I'm willing to double down as well. So that's the way I kind of differentiate between these two buckets.
Okay, so that also sounds like you are a contrarian to me.
I mean, I don't want to put labels to the way I approach things. But yeah.
But it's a mix and match of everything that you're doing. Yeah. So it's a multidimensional approach,
Huh.
which I really like. Given that there are, many flexi cap and focus funds out there, what differentiates you in your own eyes as a fund manager, and why should someone invest with you?
Sure. So again, I think about this a lot, and I think different managers can say they have different claims to alpha. But let's look at this. I mean, if you have bought into a great stock, a great name, let's say fantastic ROIC profile, let's say 30% ROIC profile, which is growing at 30%, and the market has perfectly priced this, right? What would you expect to have in that name? What return would you expect to have in that name? Let's say all the matrices are fantastic, but the market is pricing that in, right? What would you expect to have? What kind of returns would you expect in that name?
Probably average return with in line with the market, with the index.
So in some sense, you will get the cost of capital.
Yeah.
I mean, investors generally are confused great businesses with great investments. Unfortunately, that's not the case, right? And we all know this, that even if it's a great company, if it is already priced into the stock, what you make is only the cost of capital.
Right.
And if you tend to pay up on these names and the companies slightly misses on delivering on those, then the outcomes can be disastrous. So to some extent, the frame helps me to think where even if it's a mediocre company, but the hurdles are so low that if they are met, then the outcomes will be very good. So this expectations frame is, I think, the way I would differentiate, and that's the only node. I mean, the only node in which alpha gets created is when the company out delivers the expectations that are built into the price. So rather than thinking about what is it likely to deliver, etc., if you kind of think through what is baked into the price and you think these are very, very conservative estimates to begin with, you can have great outcomes. So I think that is what I would think would differentiate me to most others.
So in how Charlie Munger basically used to say, it's very hard for you to make a return in a business that has 18% ROE and to have a return which exceeds 18%. But I always think it like that. It's very hard to make a return on a company which is more than its cost of capital, because in the end every company ends up dying and you don't know where you are in that life cycle of the business. Sometimes you know sustainably, but it's very hard to tell. So thinking about that point, less than 50 companies in India account for 80% of the corporate profit pool, right? And if you look at the US, only 4% of the companies across 100 years have generated all the positive returns that you see in S&P 500, DJIA, and all those indices. So where are some of the constraints and profit pools that are being generated today, and how do you navigate that, since you also look at themes on and then go absolute and relative on those?
We have done the same exercise and we've come to realize that great investors are actually great rejectors. Okay, so you need to reject more names than you select. And let's say if you were to break down again the entire universe into ROIC quartiles, you will see that the top 25% of the companies will have an ROIC profile of 18%, right? So that's probably the area that you would start scanning with. Companies that have consistently delivered more than 18% threshold ROIC, whether those are kind of, that's not always the case, but you will have cycles in this also. But that's your hunting ground. And at this point in time, there are probably financials are the ones which kind of fit this bucket, and we are more skewed towards non-banks here rather than banks. So that's one pocket where we think at least the risk reward seems reasonable. The other pocket is the whole insurance space. Again, we think the regulatory hurdles are kind of behind, and the stock should be doing reasonably well in that pocket as well. And then there are select buckets, like for example within healthcare. There are again, there are different pockets within healthcare as well, where there is the IPM market, the US generic market. Then there is the whole CDMO piece. This is the other bucket where we think India could have a right to win. What we have done in the US generic market, where probably India has 40% market share, this is something which is also replicable in the CDMO market. So that is one bucket that we are very excited about and have meaningful exposure to at this point in time.
So again, coming back to the same question, like why should someone invest in your funds compared with so many other that exist in the same category? And also, like, what matters to you? What's your scorecard? Do you judge yourself based on index on a regular basis, or what's the frequency and the cadence of it?
So I took a long time for me to kind of get comfortable with the idea that the performance of the fund will be volatile. I cannot assure you smooth alpha. That's unlikely to happen because I'm 80% away from the benchmark. My active share is 80%, which means that I'm going to give you very different outcomes from the benchmark. Now, it's a different story whether I've taken the decisions right, but the outcomes are going to be very different. So in some sense, very short-term performance evaluation is only going to give you noise.
What's the short term according to you?
So probably 1 year or 1.5 year is really a short-term horizon. At least I would evaluate my performance on a 3-year rolling basis, because that's the investment horizon that I kind of work with when I'm looking at any name that I want to kind of invest into.
Right.
So if you are doing all of these three things right, which is getting the expectations, judging the implied expectations right, Second is business cycle. Okay, the most accidents happen when you don't focus enough attention to where, at what points are the businesses are in their respective cycles. Let me give you a couple of examples here. For you, let's talk about cement, for example. Right now, if you look at the rolling volume CAGRs on a 3-year volume CAGR of cement companies, they probably peak out at about 8-9%, right? And the EBITDA per ton would move from, let's say, 500 to 1200, 1300. Now, if you are buying a name which is already baking in these assumptions, which is more than a double-digit volume growth and a 1200, 1300 rupees of EBITDA per ton, you are probably buying these businesses at the peak of the cycle.
Yeah, that's like 13% kind of return on the capacity that they've laid down.
So what happens is, then invariably what will happen is that the earnings will not follow through. And when the earnings don't follow through, valuations seldom hold, right? So the most accidents happen when you are buying into a bucket which I call high valuation, high cycle. So this is the bucket that I pay closest attention to all the time. So what I would do is, for every sector, like I said, in case of cement, I look at volume and EBITDA per ton. Let's say in case of banks, I would look at credit costs. So if the credit costs are significantly lower than its long-term history, and the profitability on the AUM is significantly higher than its history, then you are probably in the high cycle here. So for every sector, I will have a slightly nuanced frame to evaluate where they are in the business cycle. And then I would look at valuation in conjunction with the cycle. So if let's say, imagine a 2x2 grid where I score the business cycle and valuation, there is this bucket which is high valuation, high cycle. And I'm not saying that there will not be any stocks in this bucket in my portfolio. In fact, about 30% of my portfolio will be probably in this bucket today. But I'm very actively monitoring this, and I'm looking out for signs of business cycle or the business momentum weakening. And if I see that happening, I would dispassionately get out. And I would like to invest in a name where probably I'm slightly paying up in terms of valuation, but the business cycle is at a midpoint or lower, right? So most of the names that come into the portfolio will be in this bucket. I will not be buying them at an extremely low point in the cycle, because the cycle might take very long time to turn around. So I want to see some initial signs of turnaround, but I don't want to be buying them at the peak of the cycle. The chances are I would be exiting those names at that point, right? So again, business cycle becomes very, very important, and in conjunction with that, obviously the sizing will change. So as you're going through the cycle, as you're going through the up cycle, you're probably kind of trimming down on the names that you are kind of holding. So that's how the position sizing frame, which we can talk about, will also help. So all these three dimensions probably will help you deliver the outcome.
So this is essentially a risk management framework that you have in your...
It's a risk management tool as well as a return optimizer, I would say, because when you run this business cycle frame on the entire universe that you are kind of looking out from, it gives you great ideas. It will probably tell you there are pockets of opportunities where the business cycles are low, valuations are not too high, and then it will help you optimize your returns also. So
how much of that part is like quantitative for you versus qualitative or like intuitive? Because Taleb would basically say, you know, your body perceives risk faster than your mind can process it. So like, how much is it quantitative? How much is it?
It starts out as a quantitative exercise, but it doesn't end there.
Yeah.
So what I would do virtually every quarter is look at how the earnings are moving across quarters, and if I see acceleration in earning profile, or actually earnings remaining steady also, they are good enough. But those are the starting point. Then I would want to investigate that idea, meet managements, and in fact meet competitors also, and then have a holistic view on what is happening within the sector, and then decide. So the initial part is probably quantitative, and then it kind of nudges my attention to the ideas which deserve my attention, and then I'll deep dive on those. But that part is probably more qualitative.
So when you meet managements, what are you essentially looking at? What are you judging? What is management telling you that's already not there in numbers or in earnings call? Because I believe if management is telling you anything other than that, you know, that's not a good thing. And if they are not telling you something, then what's the point of meeting the management?
So what generally I do is, again, I go back to my investment frame, which is basically again the embedded expectations frame, right? So let me give you an example so that this story becomes slightly clearer, and maybe I can narrate this through an illustration also. So let's say I'm looking at a two-wheeler name, and this is a name which is in operating in the premium end of the market, right? Now, a basic construct of the two-wheeler market is that it's a matured market in some sense, which is a GDP minus category. So it will probably grow at 5%. If you look at the two-wheeler volumes overall, have grown at that pace over long periods of time. And because this company, let's say, which I'm looking at, is operating in the premium end of the market, and something that we are seeing across different markets, that your premiumization trend is clearly happening, which means that this company is growing at faster than that market overall, right? But let's say what happens if let's say that company is growing at 12, 13%, 14%, and the EBITDA is already kind of at a point where margins can't expand any further, then my expectations frame will already be telling me that probably it's fully priced. Then I want to meet the management and see whether there are any other opportunities which could be as big as India for them to open up. Or is a market is probably can you tap into a market which you are not tapping into at this point?
So you're judging whether the expectations can be exceeded.
Yes.
Okay.
Basically, I want assurances that whatever is in the price today, the company can outdeliver that. And for that to happen, I need to know what is there in the price. Okay. Right. So that frame is, so there are 2 or 3 things that I want to understand. Can the ROIC profile of the company improve? If it is already, significantly above the cost of capital, that might not help. So what then matters is, can the growth inflect for that company? Okay. And for you to understand whether the growth can inflect or not, you would want to understand what are the niches in which they are operating, and can they get out of the niche and go into some other markets which can, extend the growth horizons.
Why wouldn't they explain it in the earnings call, and why would they explain it to you personally? Or
you tend to get lost in the minutiae where you're talking about just the next quarter. That's not something of, it's not an area of interest for me. I want to see how the company can evolve over a 5-year period. That conversations doesn't happen generally in a con call. So that is why, and sometimes you also want to evaluate management by their body language. Sometimes the body language also tells you a lot, which probably,
like what?
I mean, how comfortable are they when you are asking them a certain set of questions, and if they are not, it's kind of giving you soft clues about what's likely to happen, right? So sometimes just hearing the call doesn't help.
Has that happened, like, something that looked perfect on the paper when you met the management, and you were like, no, this is not going to cut it?
So I would put it the other way. There was an accident which happened within the company, right, and there was a perfect explanation given for it. But when we met the management, and there were 2 people out there, right, and the third person was standing outside, I met with the first person while coming through the room, into the room, and then I spoke to the other 2, and the explanations did not match. That was a clue that probably something is amiss, right? So, maybe. So, sometimes these soft clues are good enough. I mean, you don't need a very detailed explanation, but it's only when you go and meet them personally that you can get this. Right.
So you were an analyst before you became the fund manager, and you were an analyst for a long time. How long was that?
So if you include CRISIL as well, then probably it was about 18 years.
And at BNK, how long were you
16 years.
16 years. So that's a long time. During that time, like, did you ever feel that, fund managers don't do anything, and it's the analyst who is doing the heavy lifting? Because at any given time, I feel analysts know a lot more deeper about a business than a fund manager does, because fund manager doesn't have that bandwidth to go into every business, and fund manager is essentially the last person who would look at the idea and it will go into the portfolio or would be rejected. So how do you think about it now? How did you evolve?
What I realized, I mean, over the conversations that I've had on my sell side career, is that initially I was of the similar view that fund manager क्या करता है, एनालिस्ट ही सारा काम कर रहा है, इतना डीप डाइव कर रहा है, रात रात तक बैठ के रिजल्ट अपडेट्स बना रहा है. But I came to realize that analysts sometimes tends to miss the forest for the trees. You kind of miss out on the bigger picture. Just look, because you are so
Close to the sun.
to the sector that you are tracking, that you are not seeing how the value is shifting in other sectors, right? So when you develop that insight, and the other most important fact is that if you can't communicate your investment ideas in 5 sentences, then you've not done your job. But all our lives, we've been taught to write 100-page reports.
Right.
That doesn't help. So a fund manager doesn't have that much time and attention for you. So you need to communicate that idea in 5 lines. So that's how I think I've evolved in my sell side career also. I started out as a junior analyst, doing the same thing, filling up the Excels over time. But as I kind of became more senior in my profile and I started interacting more and more, not only with the analyst on the buy side, but directly with the fund managers. It's a different ball game when you're talking to the analyst on the buy side, who are by design very similar to your profile. You want to go very deep into same issues. But when you are talking to a fund manager, you have to crystallize your ideas into 5 sentences, 6 sentences. He'll not have in an hour for you.
Yeah.
So you have to communicate really quickly. And that's how I've evolved my thinking. That's actually helped a lot. And because I've spent so much time on the sell side and I was slightly senior in that organization, I could interact a lot with the different heads of sectors, which is something that I was very keenly interested in, because you tend to get bored of your own sectors. I was tracking oil and gas for like 7-8 years, and then there is nothing incremental, and in fact the reward for the effort that you're putting in that sector is also low. So you want to venture out and look at how other sectors are doing.
Yeah.
And that gives you a great frame to then communicate your message with the fund manager. You can say that this is how this sector has panned out, something that has panned out in this sector, this is how value has moved, and maybe you should look at my sector in that same frame. Whereas most of the times the analysts will be very fixated on their own sectors, looking at their own sectors with their old lens, which kind of doesn't help.
Who is more stressed out, an analyst or a fund manager? Because you have been in both shoes.
I think I would say both are equally stressed out. The analyst is physically tired, probably because he's working out till he's doing the result analysis till
Model update.
12 model updates till 12 in the night, and he will have multiple model updates. And the fund manager is stressed out because he might be thinking that मैंने गलत नाम तो नहीं ले लिया. So most of the time, most of the stress is that am I owning the wrong stock?
Professor Damodaran, who you follow big time, says that you probably cannot tell whether a fund manager succeeded because of luck or skill until that record has gone for at least 10 years, and yours is relatively nascent. Why should one invest with you based on that, and what do you have to prove to others?
Sure. So again, I'm a big fan of Professor Damodaran. People assume that he's academic, but I think he's the most pragmatic teacher that I've kind of come across. He is more close to reality than most professors are.
University.
Absolutely. The point here is that obviously that is why I say that all of that short-term performance is noise to me. What matters is the framework right? So we've tried and seen this framework evolving. So in fact, maybe there's a short story here. When I joined DSP, right? Obviously there were these two funds which they were looking out for, and I chose one of them. The large cap fund was the other fund that they were looking out for. And it so happened that I was having this conversation with Vineet, who was managing the fund then. He was very clear.
Focused.
Right? He was very clear. Bhavin, don't bother about just looking at the ideas at this point in time and what would you want to own in this fund. His mandate was very clear. Think about what problems are you going to solve, because that category as such had not created a great investment experience over time, right? So he wanted me to spend time on the category and what are you going to solve to give the investor a good experience, right? And I almost spent about 8-9 months just doing that, interacting with various other concentrated managers, etc., and distill down my investment principles. And that's what my framework talks about. But that is what matters to me, and we then try to see whether this frame works over a long period of time, and it does. So hopefully this will come through in the performance of the funds as well. So far it has, and maybe it will improve over time, but that is what matters to me. Whether so this three pillars of my investment frame, which is embedded expectations, business cycle, and position sizing, whether they will create value over time, that is what matters to me.
What were some major changes that you made when you took over the focused one?
So I think very clearly the position size of the bets that we had taken did not match the conviction that we had in those names. Clearly that was the case. So the first thing that we solved for is getting the sizing right. Okay, and I think not enough attention is paid to how do you size an idea. So in fact, when you are just having conversations with various fund managers, and he's having a certain position which is, let's say, 8%, and a certain other name which is 5%, and you ask him why 8 and why 5 and why not the other way, he would say that the conviction in that 8% idea is higher. But how does that conviction translate into a sizing, into the sizing of the stock in the portfolio? There's not enough attention paid to it. So we spent a lot of time deep diving on this aspect. I think 50% of the fund manager's time should go into ideating, and 50% of the time he should be thinking about sizing. Think about this the other way. Let's say a 1% idea which doubles gives the same portfolio outcome as a 10% idea delivering 20% return, right? So the sizing plays a big role in the eventual portfolio outcome. So you need to think through your sizing. So what I do here is basically look at a stock not through a single target price kind of outcome. So typically the analyst would have one target price on a stock. I want the analyst to think through different scenarios, and a company can go through different alternative histories, and that is exactly what I want the analyst to do. Give me at least three outcomes: the worst case outcome, the base case outcome, and a best case outcome. And then I would bet it on my own. But let's say there are equal probabilities of this happening, then is the expected value positive to begin with? That's the first thing that you need to think through. If it is, if you are going to make money only in the bull case outcome, which essentially makes that stock a lottery ticket, I don't want to buy into that idea. So then what we did is actually put the entire 30 stock portfolio that we had in that point in time through these scenarios. And then what should be the ideal position and what was it at that point in time. And then we course corrected that. So I think we did not change the names too much, but we did change sizing quite a bit from the day I started actively managing that fund. So I think that is the biggest change that I made in the portfolio. I changed the sizing meaningfully.
And what were some disagreements in the positions where people were not agreeing with you, like they should be in it or should be out of it?
So disagreements can happen. I mean, when two people are can have very different views on the same.
It's natural.
It's natural. What matters is am I comfortable with that weight or not? And that weight is not just an outcome of the conviction that there is mathematical due diligence that has gone behind it. Sometimes you think it's very academic, but it's not.
Like what?
So basically, when you put these scenarios and do what what is popularly known as Kelly's sizing formula, which is basically nothing but
Kelly's criteria.
It's just a frame. I mean, it's mathematical, but it's just a frame to think about sizing. There are multiple different ways you can think about it. What is the maximum amount of loss that I want to take on a single position is the other way to think about sizing, right? But for me, I think Kelly's formula works, and I try to do this, although it's academic, and I don't rigidly stick to that frame. I mean, it doesn't mean if the formula is suggesting a 2% weight and I have 3% weight, I'm not going to immediately trim it to 2%. It's not mechanical.
So
it just gave me broad guardrail to tell me what the positions should be. So, there could be disagreements, but there is at least a mathematical outcome which is out there.
Yeah.
And you can't fight with that mathematical exercise that you've already done, right? I mean, you take the inputs, or that he might have on that name.
I think in some of the notes also you mentioned Kelly Criterion once. So
The sizing bit is something that I've mentioned in one of.
So this is the book that has come out. So this has all of Bhavin's notes that he has taken over years, and you know, this is his handwriting. So after that, I don't feel like looking at my own handwriting, and the beauty of the notes that he takes. So it's been phenomenal, like reading his work, and you can go back and kind of recall all those things. So this book I'm carrying with me. Do you use somewhat like fractional Cali or like half Cali, as people would call it, like reduce the position size?
So it's very simple.
compared with-
Actually, I don't get it doesn't have to be so nuanced.
Okay,
What I do is basically
so mathematical.
it's slightly mathematical, but it's not very, very nuanced. It's like I mentioned, it's a guardrail for me. What I tend to do is reinvestigate my sizing at least once every
Broad idea.
broad ideas to see whether if the frame is suggesting a zero allocation and I have material allocation to that name, maybe something needs to change, right? So, but it's not does not have to be very, very mathematical. It's just broader assumptions on worst case, base case, bull case, and then what should be the ideal size of that position in your portfolio and where is it?
So one argument we keep hearing is, quality companies trade expensive and all of that, but quality also means high ROIC for a lot of people. And, again, it's very subjective how you judge the growth, the sustainability of the business model and all of that. But I saw in your framework that it kind of prioritizes earning growth over ROIC, because you have talked about how the multiples could expand faster for higher earnings growth versus going from 20% to 50%. ROIC would just be a marginal improvement in multiples.
The way I put it is ROIC has diminishing marginal utility.
Yeah.
Growth has increasing margin.
Yeah, that's a beautiful way of putting
So
it.
basically what I see is that I look at this grade, and that is where this expectations frame is a great tool to have, right?
Yeah.
Where it's not necessary. That's why I say that, you in my portfolio, I will have a Bajaj Finance also and probably a PFC also.
Yeah.
So that doesn't mean that just because PFC is a slower growth company than Bajaj Finance, it does not find a place in.
How do you compare the returns, absolute returns of these two names in your portfolio? So something like PFC, which would be 2-3% of your portfolio, compared with Bajaj Finance, which is 7.5%. How do you reconcile that? In terms of generating those growth, if the growth turns out to be unsustainable.
Yeah. So what I tend to do is, and it's, again, this might sound mathematical, but it's again a frame for me to evaluate, is that what can be the outcomes that you can have in this company, okay? And like Howard Marks puts it, more things can happen than will happen, right? So that's the great frame to evaluate risk. So if the company can grow through a very diverse set of outcomes, your sizing has to be much lower. Whereas if there are a narrow set of outcomes which where a company can go through, your sizing can be much higher. So that's exactly how it plays out in the portfolio.
Correct.
Where in one case, I can have very, very broad set of outcomes.
Yeah.
Whereas in case of Bajaj Finance, probably the set of outcomes will be slightly narrower, given its own history. Yes. And that is how I would kind of position that.
Okay. Got it. From February 2025 through August 2025, it's been kind of a tough time to find kind of value in markets based on, I assume, how you invest, embedded low expectations. And during tariff tantrums, we actually got a drawdown, decent drawdown, like, 17-18% kind of drawdown. So why were you not able to deploy during this time when you already keep 5, 6, 7% cash? Why did you not deploy during this time?
So okay, that's a good question, and also we did some introspection on this, and what we realized is that if you take a slightly longer time frame for which I've managed, for which I've supported Vineet on, let's say focus as a category, we realized that 55% of the time we have outperformed, and 45% of the time we have underperformed the indices by a significant margin. So that is something that I call out time and again, that the alpha is unlikely to be smooth, and this period is no different. Yes, the drawdown has been large and something that we did not anticipate, but we are okay with this, knowing the fact that the process is working still. And for example, what you thought is probably very defensive, let's say healthcare, underperformed significantly in this market, right? But we know we are comfortable with the fact, like I was telling you, as long as the thesis for the stocks were playing out. Actually, this gave you some opportunities to add, and in some positions we did add. So if you look at the cash position in the portfolios have come down during this period. Yes, we could have been more aggressive about this, but I think we are fairly satisfied with the deployment that we have done. We could have been a little more aggressive for sure, but like I mentioned, such periods of underperformance are a part and parcel because we are very far away from the benchmark. We are like 80% away from
80% active
and in
share.
flexi it may be slightly lower, but it's still away from the benchmark, and this will happen in such portfolios, and it's bound to happen from time to time, as long as you're being level headed during that period and doing your what you should be doing rather than just going by the noise that is playing around. Then you should be okay. So I think we'll see through this. We are seeing some signs of turnaround now in September, and hopefully that probably will continue.
So you say this is a part underperformance, right? Like, and you have outperformed since you have begun managing the fund. But over 1 year period, you are currently ranked 25 out of 41 in the flexi cap category and 14 out of 28 in uh, the focus category. What were the challenges, because this tells me on a 1 year basis your fund has done, has been an average fund. So explain me what went wrong, what went right.
So clearly, I think the way, obviously, we did not envisage the kind of tariff tantrums that we are likely to get into. And like I mentioned, the fund was slightly more skewed towards the Smiths universe than the benchmark. So if you look at the benchmark, 70% is large and 30 is mid and small. And we were, 55 was our large cap allocation. So we had higher allocation to Smiths, and that kind of hurt. And then we also had exposures to names which were more global. Like, for example, some of the largest positions were names like Samvardhana Motherson, for example. And obviously, those names also kind of got impacted. But, there's the analogy that I use here is that I think of Samvardhana Motherson as a probably one very anti-fragile company that exists in our country, where the company actually really benefits from any sort of disruptions that happens in the global market, right? So in fact, that gives their company the opportunity. I mean, this is one of the only company. I mean, generally I don't like companies to grow through inorganic route, but this is the only exception that I have in the portfolio, where actually the inorganic acquisition is actually one of the modes of the company, where the customer is coming to them saying that why don't you buy into this company, and the vendor is not doing well for them, and then they turn around the company and get the valuations for it. So we were holding that name, and obviously it did not do well, but we thought that probably this is the good time for this company, and you will have companies doing more acquisitions at great value. But you will have to live through that pain if you want to own that name.
Yeah.
And that is what we went through.
In the US, they call them roll-ups.
Okay.
The roll-ups. When I think about the underperformance over short periods of time, and you have been managing these funds for only short period of time. From my vantage point, it's just 1.5 years. It's nothing in a long life of managing funds. So how should an investor judge you if you don't have a long track record, and then at the same time you have bouts of underperformance even during this time, this short period of time. So how should one judge you? What should they look at? Just explain a little bit.
So I think the easiest thing for an investor to do is at least look at the framework document which is out there, right? So it's there in black and white. We put it out there, and like I mentioned, the three guardrails that I run these funds with: implied expectations, sizing, and business cycle. And if I'm not, if it is apparent that each of these guardrails are not held on to, where you are thinking that where you can argue that probably the a largest position in the portfolio doesn't merit that size, then maybe I'm not doing my job right. But if I can explain to you every position through these three pillars, and these pillars, like I said, have worked over time, then the portfolio outcome should be fairly decent. That's the only submission that I have at this point in time, because like you mentioned, the performance period, I mean, the track record has been relatively short.
Yeah.
What I think would work and what has worked when we've seen this over time is the framework. And I think if you are adhering to the framework, the outcomes will be really fairly decent over time.
So this is why essentially you think your process will probably outperform, has a higher likelihood of outperforming over time. Okay. So beyond performance over time, what do you think will help you stand out, let's say 5 years from now?
I think again the same thing. I don't see any other, and both things should over a 5-year horizon kind of converge, which means adherence to the core principles that I put out there. And if those principles are right, the performance should also follow through. So I don't think it's one over the other, but I think both should converge over a medium term horizon. Like I think 5 year is a good enough period to evaluate a fund manager. And I think if that happens, if the framework works, the outcomes will also follow through. And at least the one side of the equation, I'm fairly comfortable that the framework document or the framework itself, I think, is very sacrosanct.
During this time, like short period of time, have you ever like disappointed yourself?
Plenty of times. I mean, you question yourself all the time, right?
Yeah.
Whenever and wherever there is these sharp drawdowns, you question. You can't sleep well at night, right?
So what's the regret minimization framework for you? Like, or is there any?
It's very difficult to avoid regret, right? When you are underperforming, there are questions being asked to you as to why did you own that name, etc. And there's no way you can walk away from it. But the best that you can do at that point in time is go back to your investment thesis. That's where it becomes very important that you document your thesis.
Yeah.
Be very clear about it and test that whether is that thesis intact. That's the only thing that you can probably do.
So during this time, like, what are your one or two portfolio actions that kind of deeply disturbed you, question yourself to a point where like, am I even meant for this? Because this happens all the time, right?
So, when this whole tariff tantrum was happening, there was this whole question mark as to what happens, what if, meaningful tariffs are imposed on the Indian pharma companies, what happens? And we had significant overweight positions in that space, right? But then when you went back and you kind of reinvestigated your thesis, India is probably one of the lowest cost producer out there. The manufacturer is not making the most money. It's the value chain, the middleman, which is making the most money. So if the tariff were to be imposed, the weaker players will get out of the market, which means the existing players, which are backward integrated, relatively stronger, should gain out of this. And that gave us comfort that it's very unlikely to happen. Even if that was to happen, it will reduce the tail of the market, give more pricing power to the existing players. And so we could hold on to the positions that we had in the portfolio.
So it was unlikely.
That made us really uncomfortable. That you don't know what policy action is coming next.
Even though you knew that there was a low probability of this being hit by tariff.
But that situation was very fluid at that point in time, and you did not know what was coming next.
But still, odds were in your favor that you believed. Yeah. So, given current valuations, which I feel are expensive, value is hard to come by, specifically based on how you invest. And what is your expected range of return range over the next 3 to 5 years for your own portfolio?
Sure. So it's very difficult to call out what. I mean, if you look at broadly, the broader markets have delivered 12-13% return, and like you mentioned, I agree that the valuations are slightly overextended out here, which means that in the medium term, probably the return will be lower than this number. And like I mentioned, the way we have designed or constructed the portfolio, the earnings growth which is embedded in the stock, because I don't tend to rely a lot on the re-rating potential of the stock. That's my margin of safety. So the earnings growth should translate into stock returns, and again, this is not something that I'm predicting, but the earnings growth for the previous 5 years have been 16-17%, and in my assumption, it should mirror that history, hopefully. So that's the way I would look at it. I don't know whether the returns will be in the same trajectory, but I have not, at least in my mind, I have not paid up for re-rating. And if that's not the case, the earnings should translate into portfolio returns over time.
So what I am understanding is even if the earnings growth is turn out to be somewhat unsustainable based on what you have modeled, you'll still
Have
come
some
out better.
margin of safety is there.
Right. Got it. Got it.
The other way I also tend to look at this, and which is I found it very intuitive, is when you look at, let's say, the implied expectations, and let's say it's telling you that it's 12%. Let's say hypothetically it's a 12% number, and if I were to look at a company and look at all the variables in the company, and it's telling me that the base case here is likely to be a 14%, 15% earnings delivery, right? So if you look at the expectations versus the expected delivery, that ratio is less than 1. That also tends to give you a lot of comfort. So rather than looking at multiples of the portfolio, what is the price to earnings of the portfolio or the price to book of the portfolio, I look at this number,
Right.
which is the implied expectations which is there in the price today versus a 3-year delivery. And that number for me is today at about, let's say, 67-68%. And if I look at the broader market, this is close to 90.98, so 98%. So markets in some sense are fairly valued, and I think there is some margin of safety in the portfolio. That's the way I would kind of look at it.
Got it. So you talk about slugging ratio a lot as well. Can you explain that? How you think about
So
it?
the way I think about, let's say you are looking at a company, right? And the company is delivering, let's say, 50% return on capital. Now that return on capital can come in two ways. It can come in through 25% profit margin and 2 times asset turn. Basically, it's a multiplication of these two. How many times you turn over, how many times you sell versus what you have invested. That's the asset turnover ratio. And what is the margin that you are earning on what you are selling, right? That those two multiplied gives you the return on capital employed, right? And you can have different combinations of this. So you can have a company which is turning the sales at 10 times, but the profit margin is just 5%. That can also give you a 50% outcome. Exactly this also works, I think, in investments, where you can have higher turnover, which is compensated by lower returns per trade. So in some sense, in my mind, although the portfolio turnover is not high, but I'm not very focused on that number. What matters to me is eventually what is the outcome. So it could mean a slightly higher turn and a lower per trade kind of return. But if the outcome is satisfactory, that is what matters to me. So I keep on monitoring what is my success rate in the individual names that the individual decisions that I've taken, and we've kind of explored this concept on a 2x2 grid, like I mentioned. And if of 60% of my decisions are good decisions where whether the outcome of is good and bad does not matter. So I evaluate that very closely, and I also evaluate what percentage of my times the decisions have been in terms of outcome has been good. So I think if these two metrics are giving you kind of the same information, that is what matters.
What are the themes that you are currently invested in?
So like I mentioned, financials is something that we like, but
Lenders?
non-banking lenders, NBFCs versus banks is something that we are preferring at this point in time. Insurance is something that we are liking. Healthcare as a bucket within that, CDMO as a space is something that we continue to like. Oil and gas is again a bucket where we think there is a lot of value, and hopefully
Still on BPC, yeah? Right.
I like that name.
Yeah.
Basically, the company is giving you, I guess, about 16-17% earnings yield today.
Right.
And a 6% dividend yield. It's very difficult to lose money when you have such odds. But obviously, things can go wrong.
Right.
But based on our own interactions with MOPNG, very recently we met up with them, etc. The idea is to create value over time. And in India, I think the oil is not peaking till 2050. So these are not very.
Oh, really?
Yeah, if you look at a lot of other material that is out there published on India's oil consumption, I don't think it's peaking anytime soon. In some sense, these are not very short-term bets that we are kind of calling out.
Okay, and not even with the EV and autonomous
Doesn't
growth
seem
and
that it
everything.
will peak out before 2050. In fact, the minister is
For 25 more years?
In fact, the minister is on record saying that India will probably emerge as one of the global hubs in refining, one of the 3 global hubs in refining.
Give me 1 or 2 examples of companies where you have variant perception today in your portfolio.
Let's look at a company called Gas Authority of India,
GAIL.
Okay, so let me just talk 2 minutes about my investment frame on PSUs, which will kind of help you think through this. One very, very important criteria for me when I'm evaluating PSUs is there private sector competition out there, or these are like virtually monopoly franchises, right? When you have very real tangible competition, then market wants deep discounts to fair value in case of owning PSUs, because they can directly have private proxies to play with. And then there is the other bucket where they are virtual monopolies in that space. For example, let's think about power as a theme or defense as a theme. These are large SOE owned companies, which is the only way that you can participate in that theme. So one such bucket is transmission. Can you think of a name which is doing transmission? I'm not talking about distribution here. There are plenty of CGD companies, but can you think about any name which is there in long distance transmission, which is there outside PSUs? There is none.
No.
Right? So this is one unique name in the sense that it's
Petronet LNG probably
it's
does a
owning a
little bit,
terminal,
and it's also,
but there is competition.
Yeah, and it's a PSU again.
It's
outside PSU.
it's
Somewhat
50%
PSU.
government hold,
Yeah.
semi PSU, but
Yeah.
it's not really a PSU. On the trunk pipeline, it's virtually a monopoly, right? Now we all know that regulation allows them to earn 12% return on capital. Okay, so that's a given. But what is not very popularly known is that there is another segment, which is gas marketing, where there is no capital employed. Okay, they earn higher margins on their marketing business than what they earn in almost similar percentage margins are in fact higher, but almost similar profitability on the marketing side. So if you combine the two, conventional metric to look at this business is you just look at the regulated returns that you are earning. But if you were to include this part of the business within because only a gas transmission company will be also, I mean, it's very obvious that it will be easier for them to market that volume also. And that percentage, which is the marketing percentage to transmission, is increasing over time, right? So in that case, the return on capital is actually 18-19%. Now, if you evaluate that from the frame that I talked to you about, that ROIC and growth frame, it will give you a very different outcome. And again, the popular gripe that investors have against this name is that they have been investing outside their own domain. We did the 10-year analysis of this company and we realized that 90% of the capital allocation went into the transmission business.
Narrative versus facts.
Yeah. and by the way, not only that, in marketing, they've never lost, except 1 year, they've never lost money.
Yeah.
And virtually zero capital employed. So when you look at this company from that lens, you will realize that, you know, the way you need to kind of think about valuation of this company is not conventional utility frame, right? Where you earn just a 12-13% return on capital. It's much better where you have a part of the business which virtually consumes no capital, but only a transmission company will be able to do it.
And do you think like they have call option value in some of the subsidiaries they own stakes in, because they are also trading?
So we are not even talking about that. So we are today, we know few of the listed private sector peers are getting the same market caps as GAIL, and GAIL has 50 GAs within it.
Yeah.
Some of them,
and it has what 65% market share in like transmission.
Yeah. So it's a virtually there are only 2 or 3 companies out there, and all of them are state owned.
Yeah.
And these are the only companies which have invested in pipeline network, which is why the network is not optimally utilized today, because a lot of investments have gone into laying of these pipelines over the years, and which is why the return is today suboptimal. Which means when the volumes come back, there is this big swing in earnings that is potentially out there.
Who are your investing heroes? Who is your favorite? Who did you kind of grow up in investing career kind of reading?
So in fact, like I mentioned, I've been for a very long time, I've been on the sell side, right? Which meant that I had an opportunity to interact with several senior fund managers, CIOs, etc. So I would say that I don't have a single hero, where I found a lot of opportunities to interact with multiple different people, and each of them give you a very different insight into investing. For example, one of the note that I put out in this book is S. Naren's investment philosophy, which pays a lot of attention to cycles.
Yeah.
So that taught me that you need to respect cycle a lot. I mean, this is something that is very, very ingrained in my investment frame today. Similarly, within the organization also, I tend to learn a lot from the other senior fund managers that are out there, Vineet, Rohit. So from Vineet, what I've learned is that you need to be very patient with your investment frame. So when you're invested into idea, and you need to nurture it, and you need to stick with it for some time before it starts delivering return to you. Right. You have to be patient. Rohit is equally, you have your investment thesis, but you have very loosely attached to it. So if that changes, you have to change your mind. If the facts change, you will have to change your mind.
Yeah.
So you have to be, you have to have your ideas loosely held, not very tightly held. So that is something that I've learned from Rohit. So I've picked up different, and in fact, there's a part of the book also where I've written about different investment frameworks from different fund managers, which have helped me evolve my thinking over time.
Yeah. Well, it sounds very original to me. You call it unoriginal.
Because it's not, because all of these ideas are borrowed ideas, and that's why I thought it's only fitting that we put it as unoriginal.
Any favorite investing books?
Plenty actually, but obviously the ones that I like the most is Poor Charlie's Almanac, especially his description of Coke and how do you create $1 billion enterprise.
Trillion.
Trillion. And the other one is More Than You Know, Michael Mauboussin.
Yeah.
So some great investment frames, I have multidimensional thinking, then obviously expectations investing and the dark side of valuation, I think.
Yeah, expectation investing. I also handed out a few copies to our colleagues. It's a fantastic book. Yeah. So thank you, Bhavin. Thanks for being here, and thanks for giving us time. It was a lovely conversation.
Thank you so much.
Like I've always enjoyed and reading your wonderful writing and drawings. I look forward to reading that.
So I really enjoy the conversation that we had, and I've kind of picked up on some of the stuff that you've been writing as well, and I really enjoy reading those the stuff that you've put out there. And I also kind of very closely monitor what you are holding in your portfolios also, so it kind of gives me ideas to work on. So that has been very helpful.
Well, pleasure. I didn't know anyone was reading what I write, so good to know. Thank you. So it was a real pleasure getting to know Bhavin today. How much investing boils down to having a sound process that you can trust through cycles, ups and downs, is very important. That is what stood out for me from this conversation. Bhavin was honest in how he manages the fund and how he thinks about underperformance and outperformance and why he thinks he will outperform over a period of time. So I believe you have gained something from the conversation as well, like I have. Thank you. Until next time.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.